As of February 26, 2026, the iShares MSCI Malaysia ETF, ticker EWM, has become a primary focal point for investors looking to capture the Silicon Shield of Southeast Asia. While global headlines often focus on the tech giants of the West, Malaysia has quietly spent the last 2 years transforming into a critical node for the global artificial intelligence (AI) supply chain and a preferred destination for multi-billion-dollar data center expansions. Earlier this month, on February 18, 2026, EWM reported a year-to-date total return of over 8.1%, continuing a powerful momentum that saw the fund gain more than 15% in 2025. For an investor today, EWM represents a play on a triple-engine economy, a surging semiconductor sector, a stable financial backbone, and a currency, the Malaysian Ringgit, that has become one of the strongest performers in the region. 1. The macro thesis: why Malaysia is 2026's dark horse. For decades, Malaysia was seen as a commodities play, palm oil and oil and gas. In 2026, that narrative has shifted entirely. The country is currently riding an investment upcycle that hasn't been seen since the 1990s. The China Plus One beneficiary: as global corporations continue to diversify their manufacturing away from China, Malaysia's Penang and Kulim regions have become global centers for advanced packaging in the semiconductor world. The semiconductor surge: Malaysia currently accounts for roughly 13% of global back-end semiconductor testing and packaging. In early 2026, the government's National Semiconductor Strategy, NSS, is entering its peak phase, aimed at moving the country up the value chain into actual integrated circuit, IC, design. The data center gold rush: because of its proximity to Singapore and its reliable energy grid, Malaysia, specifically Johor, has attracted massive data center investments from the likes of NVIDIA, Microsoft, and Google. In 2026, this is translating into a huge boost for the utility sector, which is a major component of EWM. 2. Inside EWM, the Fortress Portfolio. EWM tracks the MSCI Malaysia Index, which focuses on large and mid-sized companies. Unlike some growth ETFs that are volatile and tech-heavy, EWM is structured like a value fortress with a surprising growth kicker. The financial bedrock: approximately 50% of the fund. The most defining characteristic of EWM is its heavy concentration in Malaysian banks. Malaysian banking, Maybank. The largest holding, Maybank is a regional giant that provides a stable, high-yield foundation. Public Bank and CIMB Group. These 3 banks alone make up nearly 40% of the entire ETF. In 2026, they are benefiting from the massive influx of foreign direct investment, FDI, which is driving demand for corporate loans and infrastructure financing. The utilities and infrastructure play: Tenaga Nasional, TNA. As the national power provider, Tenaga is the hidden winner of the AI data center boom. Every new data center in Johor needs massive amounts of electricity, and Tenaga is the primary provider. In 2026, the company is pivoting towards green energy to meet the ESG requirements of big tech firms, making it a favorite for institutional investors. iShares Healthcare, a global healthcare provider that gives EWM a defensive edge. As the regional population ages and medical tourism to Malaysia increases, iShares provides steady, non-cyclical growth. 3. Performance and real-time vitals. As of this week in February 2026, EWM is trading in the $29.50 to $30 range, hovering near its 52-week high. The investor scorecard: dividend yield. EWM currently offers a trailing 12-month yield of approximately 3.1% to 3.4%. Dividends are typically paid out semi-annually, June and December. Valuation, PE ratio. The fund trades at a price-to-earnings ratio, PE ratio, of roughly 15.2 times to 15.8 times. When compared to the high valuations of US tech, 30 times plus, or even Singapore, 17 times plus, Malaysia is increasingly viewed as an undervalued gem in the Asia-Pacific region. Expense ratio. The fund has a gross expense ratio of 0.50%. This is standard for a single-country emerging market fund managed by BlackRock/EWM. 4. The Ringgit factor, a hidden tailwind. For a USD-based investor, EWM isn't just a bet on Malaysian stocks, it's a bet on the Malaysian Ringgit, MYI. In 2025 and early 2026, the Ringgit has significantly appreciated against the US dollar. The yield spread. As the US Federal Reserve began its rate-cutting cycle in late 2025, the interest rate gap narrowed, making the Ringgit more attractive. Repatriation of funds. The Malaysian government has been successful in encouraging state-linked companies to bring their foreign earnings back home. This has created a floor for the currency, meaning that even if the stock prices in Malaysia stay flat, a USD investor could still profit from the currency gain. 5. Critical risks, the 3 Ts. Before investing in EWM this week, you must be aware of the specific risks that could affect performance. Tariffs and trade relations. With shifting global trade policies in 2026, Malaysia is under the microscope. Because it is a major transshipment hub, Any new tariffs on solar panels or semiconductors coming from Southeast Asia could hurt EWM's manufacturing components. The AI bubble risk. Much of the 2025 growth was driven by the anticipation of data centers. If the global AI capex cycle slows down, or if big tech firms delay their Malaysian projects, the utilities and construction sectors in EWM could see a correction. Commodity sensitivity. While tech is the new driver, Malaysia is still an exporter of oil and palm oil. If global energy prices collapse in 2026 due to oversupply, the broader Malaysian economy will feel the impact. 5. Strategy. How to approach EWM today. If you are looking at EWM in late February 2026, you are entering a market that is no longer cheap, but is arguably fairly valued for the first time in a decade. The satellite holding. Most advisors do not suggest making a single country ETF like EWM your core holding. Instead, it is best used as a 3% to 5% satellite position to add diversification and yield to a portfolio that is too heavy on US tech. The momentum entry. The fund is currently in a technical uptrend. Buying into strength can be rewarding, but given the 15% run over the last few months, a staggered entry, buying half and half later, is a prudent way to manage the risk of a short-term pullback. The yield seeker play. For income-focused portfolios, EWM's yield, backed by some of the most profitable banks in Asia, is a competitive alternative to low-yield Western markets. Conclusion. The rebirth of the tiger. The iShares MSCI Malaysia ETF, EWM, in 2026 is a story of a tiger economy that has found its place in the digital age. It has successfully moved from being a commodity shop to a high-tech factory for the world. With a price-to-earnings ratio that remains reasonable, a currency that is recovering, and a portfolio accommodated by banks that are benefiting from FDI cash, EWM offers a rare combination of income, stability, and growth. While the trade war risks are real, the structural shift in global manufacturing makes Malaysia a must-watch for any serious global investor this year.